Hello, everyone, and thank you for joining us for today's webinar, Top Tax Topics Impacting Businesses During COVID-19. I've got a few housekeeping items to go over with you before we get started. To qualify for CPE, you must actively respond to all polling questions and stay on for the duration of the broadcast. There are 4 questions, so you must answer at least 3. If you miss a chance to respond to a polling question, submit your response via the chat. Questions or comments for the folks teaching this course today, submit via chat. If you'd like to be unmuted to talk, send in a chat request. We're likely going to have a lot of content to cover today, so we'll probably hold those questions until the end or answer as we have time. Next slide. Learning objectives for today. We're going to review at a high level the latest updates on federal and state regulations. We're going to discover key opportunities for discussions around NOLs, compensation, international tax, and more. We're going to identify when you should contact an expert on COVID-19 tax matters. And with that, I will turn it over to David Sordello to do a quick introduction of our panelists.
Good morning, everybody. I guess some places it's not morning anymore, it's noon or 1 o'clock. So thank you very much for joining us. We're excited about putting on this presentation. Obviously, this is a different time for everyone. We are all pretty much working from home these days and sequestered into our houses. We're all coming from the Bay Area, and we've actually been doing this for 2.5 weeks, so it's kind of the new normal. But you know, Zoom and these webinar things are really good for kind of staying in contact and hearing what's going on. So we appreciate everybody joining us today. My name is David Sordello. I run the tax practice at Armanino. I'm also a corporate tax partner, and I've been practicing for over 30 years and with Armanino for about 14 years. And my bio is there, so you can read it if you want to, or look me up on the web. I won't go too much into my history, but I'm pretty much a domestic tax person that specializes in ASC 740, as well as working with companies of various of all different sizes, from startups to large public companies. With that, I also have, if we can advance the slide, I also have David Greenemeyer, who's a fellow partner of mine, also a domestic tax partner that spends a lot of his time in the ASC 740 area, as well as deep in technical accounting. And David's been here a number of years as well. And finally, I have Matt Fricke, who's been our resident expert for the last few weeks. He's been buried in the tax acts and the different things that have been happening, both from a tax perspective and outside of a tax perspective. And we'll cover a little bit of that here as well. But has spent a lot of time just buried in what's going on right now and how it's impacting different businesses and people in regards to tax matters. So with that, I'll turn it over to Matt to kind of kickstart the presentation and maybe just go through oh, actually, we're going to do a polling question, sorry.
Thanks all. First polling question, again, if you're here for CPE, why are you listening in today? A, I was hoping for a break from social distancing. B, I heard you were the best tax team in town. C, I'm just here for the CPE, which is fine. Or D, all of the above. Make sure you get those answers in. We're going to quickly run through this and close the poll in 3, 2, and 1.
Cool.
Love it.
I like all the above, yeah, so great. Okay, so now I'm going to turn it over to Mr. Fricke. So here's our agenda. I guess I'll go through this. So we're going to cover federal and state, kind of the ramifications of the CARE provisions, which changed, what opportunities there are as a result of that. Then we're going to touch on a little bit of the impact to ASC 740 and GAAP accounting around this. It's a pretty big event, and so we're not going to focus totally on that like many of the Big Four webinars seem to be doing. We just want to touch on some of the highlights and important areas there for the companies that are dealing with that at quarter end right now. And then we're going to go into some of the opportunities some of the areas of either opportunity or concern, given everything going on in the environment. A lot of these don't have really to do with the CARE Act or the stimulus package, but they interact with that, as well as changes in value, changes in interest rates, and a lot of the other issues that the country's going through right now. And then we're going to end it with the government aid update that I know everybody's always is very focused in. You know, I've been watching CNN since really early this morning, and they've been talking quite a bit about what they call PPP, the Paycheck Protection Program, as well as other things that to getting funds out to small businesses to keep people employed. So we're going to touch on that and a couple other areas around that at the end here. So with that, I will now turn it over to Mr. Fricke to kind of take us to what the laws are and where they came from and kind of what we're dealing with.
All right, thank you very much. We can click to the next slide and we can walk through this. So thank you for joining us today. I know hope everybody's healthy and hopefully happy as well. To David's point, we're facing incredible economic times, and the federal government has taken unprecedented actions to maintain the economy. Right? If you look at the changing landscape of legislation, that's impairing many companies and service providers alike their ability to make sound business decisions. So this webinar is meant to kind of assist you with some of those impacts and help you determine a path forward. To know how quickly our approach is changing, just to consider a few weeks ago, we had the deferral of tax payments for April with limitations on deferral amounts. And a few days later, they changed the extension of time to align with that deferral period. And as soon as we did a press release on that portion, a day later, they went and lifted the limitation amounts. So it seemed after I directed my clients one direction, well, I need to call them back and move a different direction. So it's changing, it's fluid, and we're trying to track that on a daily basis. But let me lay out the quick landscape pertaining to the two major bills passed, Phase 2 and Phase 3. So on March 18th, the Families First Coronavirus Response Act was in effect. That was the second law passed. It impacted agencies of every avenue of government, whether it's food and drug, defense, financial services, and government. The list was on. It goes on and on and on. It basically expanded food and nutrition services and provided emergency state unemployment insurance grants and increased medical funding for states on the COVID testing. While a myriad of topics were addressed, it contained certain tax elements that people keyed in on. The mandated paid leave and provider employer tax credits. So the main elements were emergency paid sick leave and emergency family and medical leave. To support the expense many companies are faced in this mandate, the bill afforded tax credits for paid sick and family and medical leave acts. There's extensive analysis that was required to do that. There's a lot of qualifiers, who was impacted, whether you're on leave, furloughed, whether you could stay at home and work, was that a qualifier or not? We jumped through all those hoops there. All I can say is if you're going down this path, you probably got to talk to your employment attorney. There's a lot of nuances in there. The third Corona relief package, the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act. I don't have to say it again, right, David? I'll just call it the CARES Act. HR 748 is now law. The CARES Act, in many ways, shifted the burden of unemployment from the state rolls to that of the employers and corporations and provided funds through grants, loans, credits, and beneficial tax provisions to support the financial burden. So in addition to many of those, and there's also individual support reliefs in that bill. But on the corporate side, which is our focus today, we can kind of address some of those areas, and Dave's going to go in detail about that. There's employer retention credits, there's delay of payment of social taxes, there's modifications of NOLs, relief of the 80% limitation, acceleration of AMT credits, changes to the deductibility of interest, and there's also some corrections on the TCJA of 2017. Well, one of the other areas that David touched on earlier is they also made available government loan programs, grants, and credits. So the small business interruption loans were really geared to provide significant relief for all those businesses affected by COVID-19. And there was qualifiers on some of these with potential loan forgiveness, and the forgiveness even being non-taxable. So that's the PPP. We'll talk about that in depth later. But it was a short read of the bill. It was 880 pages. We went through it a few different times. But that's kind of a high-level overview of as I saw it. And David, I've missed something, let me know, but I think what makes sense is kind of jump into the next slides and let you kind of talk about specific areas within the corporate taxation world.
Right. So this is going to center in on a lot of the real tax, if you want to say real tax, income tax, federal income tax area, and what the CARES Act has adjusted. So if you remember your history and you go back to prior to the Tax Act in 2017, the tax reform, We used to be able to carry back net operating losses. It's changed over the years how many years you can carry back. And if you've been in this business as long as I have, it's been anywhere from 3 to 5 years. Every time we go into an economic crisis, the 5-year provisions seem to come back. So basically 2017 ended the carryback ability. So from 2017 on, the idea was you were only going to be able to carry forward net operating losses. They were going to have an indefinite life, and those losses that were post 2017 would be able to offset tax at 80%. So it's kind of like they got rid of the AMT, but they kind of wanted you to pay a minimum tax anyway. So they put an 80% clause on it. Pre 2017 NOLs, you could use up to 100% and wipe out your income with those, but those still had the 20-year life from the original loss period. So basically what this act did is it went back retroactively and said for all those years, 2018, 19, and 20, you can now do a 5-year carryback from each one of those. So what that means is from 2018, you can go back to 2013. Obviously 19, you can go back to 14, and 20, you can go back to 15. So there's a lot of room to carry back. So taxpayers who had paid tax in those earlier years, anywhere from really from 13 on, there is a really big opportunity at this point to go back and get those tax dollars. There's also a technical correction, and this is just, for noting that there was a error in how they wrote the Tax Reform Act in 2017. They basically forgot the straddle years for non-calendar year companies. So that weird 2017 or fiscal year end 2018 NOL wasn't allowed to go back. It kind of got stuck. And so those companies weren't allowed to carry back. So they kind of fixed that, and they're now letting the 2017 loss, if you couldn't carry it back before because you weren't a calendar year company, go back 2 years as well. So that's another opportunity for those companies. So, the biggest thing here, so basically what we're telling people, if you have dollars sitting back from 2013 on that you paid in tax, and obviously those were some pretty good years, a lot of them, then this is the opportunity to go get those dollars back. Even better, remember tax reform changed the tax rate from 35% down to 21, which was a great thing. But what this gives us the opportunity to do is take NOLs that in the future will only be benefited at 21% and actually go back and get 35% tax dollars. So it's a permanent benefit. Obviously there's a 14% spread between using an NOL after 2017 and before 2017. So this is a pretty big deal, again, for the companies that do have income back then and now are generating a loss. And obviously we're seeing a lot of companies that are expecting to have a loss this year as a result of the economic crisis caused by this virus and all the shutdowns and everything else that's happened associated with it. And there, in addition, there's a lot. This is a layering exercise, because when you layer on carrying back NOLs with all the changes in tax law, both there's a Gap ad, apparently we're sponsored. Both pre and post, the law change, there's a lot of interactions with different code sections that are going to happen. Anybody who's international, there's been new provisions that pull in international income, and this will the carryback of NOLs will intersect with that and cause some level of complication and recalculation. But generically, this is a really good thing for people who have taxable income back in those days. It's a way to instantaneously go back and do carrybacks. We'll go a little bit more into some of the other planning around this. You can see the chart there. We're going to distribute these slides so you don't have to write any of this stuff down, but this is just the carryback period, carry forward period, etc., that is now in effect. So if we move on. So other really important provisions that kind of layer on to that or or independently, depending on if you're in a loss or not. So one of the big changes they made in tax reform, and this particularly hit certain like PE-backed companies really, really hard, because obviously they leveraged up to buy the company, and that's always been the way that PE companies buy companies. But what they did is at that point in time, they put a limitation, which is called 163J, in place on the deductibility of interest. It basically was a certain percent of kind of taxable income, mainly EBITDA at this point in time in the law. So before depreciation and amortization, you were limited to 30% of that number as your interest deduction. So if your interest deduction was higher than that, it carried forward and was not deductible in that year. So what they did, knowing there's going to be a lot more debt and issues associated with this, is they raised that limit from 30 to 50% for 2019 and 2020 only. So that gives a little bit more room of interest deductibility. That can also interplay with more of that interest being deductible and causing a net operating loss in a year that therefore you can carry back. So those two things kind of go together. If you're in an income situation, it might give you more deductibility and just pay less tax as well. The next thing they did was also
David, just one other item on the interest expense. Another big benefit is companies can elect to use their 2019 adjusted taxable income, which could potentially be higher since everyone's expecting big losses in 2020. So you can make that election and likely get a much higher interest expense limitation. So companies should keep that election in mind and possibly use their 2019 adjusted taxable income.
Yes, thanks, David. That's a great point. The next one was a correction to the tax reform. When we did, if you remember, in tax reform, they allowed for 100% expensing of certain assets purchased after 2017. When they did that, they left off assets with a greater than 10-year life. So leasehold improvements and other assets were not allowed to be expensed and continued to have to be deducted under normal makers or other depreciation systems. So they've gone back and fixed that and basically given you the ability to go back to 2018 and amend your return in order to take that deduction. It's basically, the rule was always that you could include these items as being expensable. So again, even if you don't have a net operating loss and you paid tax in 2018, that could be a benefit to reduce the tax. It also could be a benefit to put more loss in 2018 that you can carry back all the way to 2013. So again, that goes into modeling what's the best answer. The other way that we're believing that this is going to be allowed, and it may be beneficial again for certain clients, is to file a method change, which is called 3115, and file that in either 2019 or maybe even in 2020 and get kind of a catch-up deduction of what you would have been allowed earlier. So it just recalculates how the difference between if you had expensed it or what you've actually deducted so far. So again, figuring out where you want the deduction, this gives you some ways to play around and make sure that you're getting the best answer based on when you had taxable income and all the different factors associated with that. There's also a pretty big thing from a real estate perspective, the ability to write off costs to improve facilities is a big deal there. So that's also been put into the law. And then the last thing here on the sheet is the refund of the prior AMT. So when they eliminated alternative minimum tax for corporations in 2017, they had this kind of quirky rule where you could either use it up as a credit against future tax, or every year that you didn't use it, half of whatever was left in your that you had paid AMT previously would be refunded to you each year. So and they've been pretty slow, honestly, and a lot of times paying that off. So basically what they've changed here is they said, okay, you don't have to do that anymore. Any AMT credit that you had paid prior to 2018 that you still have sitting, out there as a refund from the IRS, we're going to refund it in 2020. So, and there's definitely mechanisms out there for companies to apply for that refund and get that process moving. So that's, again, a cleanup to get money to people faster that the government owes the taxpayer anyway. So if you want to move on, and obviously if you carry back NOLs, and because there previously was AMT before 2017, you might generate an AMT tax, and therefore this will allow you to get all the money back through, you know, one way or the other, whether it's through the carryback claim or through the AMT credit refund and get it back now. So that's a pretty big deal there. So a couple other things here. There's a couple other technical corrections for qualified improvement property, eligible for 100% bonus depreciation, as we kind of covered earlier. That's the fix of the bonus depreciation, and that's the one you can go back to 2018 or catch it up. There's also some rules around this interest deductibility, and this has a lot to do with companies that have international operations and have the global international intangible tax, the GILTI, as we call it. There's changes that basically change the life of assets that could lower the amount of the GILTI tax, and thereby not having as much income taxable in the US, especially related to interest deduction. So that one actually has a lot of complexity to it in kind of calculating this GILTI inclusion in the US. So that one has our international tax people jumping up and down in terms of how do we figure that out, and especially when David gets to the provision considerations, what does that mean from a tax accrual basis as we try to estimate that right now. And we can read the rest of it. The bottom one has a lot. This has a huge benefit to real estate companies, just, you know, changing the rules for non-residential real property and shortening the life of those, the depreciation related to that. So we can move on. Okay, so fortunately there's only one federal government. The problem with some of this is that, you know, there's a lot of states that have income tax, most of them. And the problem, as we discovered when we had tax reform, is that some states will right away adopt a federal provision, and some states won't. Some states, like California, for instance, need to do their own conformity. And in fact, California hasn't even conformed with all of the changes from the Tax Reform Act of 2017 yet. They're slowly catching up, and they've conformed to some of them, but not all of the provisions. And so we're already dealing with different rules for California than federal, and there's a lot of states that are like that. So this is going to be another one where some of these changes, like bonus depreciation and 163J, the interest deduction, that the states are not going to conform. Also, because, you know, the state can't do what the federal government can do and just print off $2 trillion and distribute it, you know, in small bills out to everybody in the world and through these loans that are going to be forgiven. They can't really do a lot of the things the federal government's going to do. So they're probably not going to allow carrybacks like the federal government, and there won't be as much refund opportunities. Although I did see that New York actually just is passing tax relief. And so we do expect states to independently try to provide relief for both corporations and individuals in their state as we go through this crisis. So that is another thing, that states will do their own thing as we go through this. So there'll just be a lot of disconformity with the federal government and the state government, and what that means in terms of what tax you have to pay when and how it's calculated between the two of them will continue to be, you know, problematic. So the big thing with states that we're seeing is, because you're probably not going to be able to carry back the loss, what's really important if we're generating losses is to figure out how to put as much of the loss in a state that's going to give us a benefit going forward, and not a state that is not going to give us a benefit going forward. So looking at apportionment and allocations of costs, as well as how we allocate the loss to different states, is really important to get that benefit, for the future, as opposed to the carryback rules for the federal. So we're really spending a lot of time looking at the different state rules and how we can make sure that we're getting as much as possible the losses in the right states that we'll get a benefit for. So again, it's pretty complex because they each have different rules and they keep changing how they're doing apportionment. And obviously this is a one-time event. Some of these expenses that companies are incurring might be able to be treated differently than normal regular business expenses. So those are a lot of the different things that companies are looking at, and we've been working with people on. And then just here at the bottom, most of the states have extended filing and payment deadlines. Most of those are automatic changes. A lot of them conform with the federal rules and timing, but not all of them. So you need to make sure that you're checking to see when certain things are due, and not just follow the federal rules. I've had a lot of people approach me lately with when is this due? It's due here in Texas, but when is it due for federal, and when is it due in California? And they're not all the same. They've all kind of gone their own way. We do have on our COVID-19 site, we do have a pretty detailed matrix that you can look up a lot of these different things for each state, if you're looking at when things are due and what relief provisions some of the states have allowed. There's definitely opportunities. What we have found is through this crisis, the states are trying to help. The way that they can help is by allowing you to defer payments of things you would normally have to pay, maybe being a little easier on settling disputes because they need the money, but they also, they're all working from home too in a lot of the locations. So we've really seen that they're easier to deal with, and they want to conclude things much quicker than they normally do. They normally drag things out forever, and use that as a tactic. So we're seeing a lot of states let you defer payments. One of the things we're doing for a lot of clients that collect sales tax, for instance, is calling the state up and asking them if we can pay that at a later date because we need the cash. And California and Texas have both been really good. If you call them up before it's due to say, yeah, here's the terms. It can be a little bit of a tracking nightmare, but it is an interest-free loan basically at that point in time, and definitely, worth the effort if it's sizable enough. And the same with the due dates and payroll tax reports and due dates extensions there. So kind of have to track when everything is due, what opportunities there may be to not make payments and hold on to the money longer, as well as dealing with, non-conformity and different rules in each state amongst the, obviously being different than the federal provision. So a lot there. Obviously, there's a lot of states, so a lot of complexity. So we want to move on.
Thanks, David. So we're on to our second polling question. True or false, states are likely to conform to all federal provisions. A, true, B, false. Should be an easy one. We'll close the polls in 3, 2, and 1. Most people paying attention, doing good. Of course, the answer is false. Keep moving on.
It depends what state, so yeah.
Well, that's true.
Okay, so David Greenemeyer, let's take us through a high level of what this means from a ASC 740 tax provision.
Yeah, thanks, David. As David mentioned before, we could probably have a full 2-hour webcast just on the impacts to tax provision. So I'm really just going to try to go through some of the high-level points to get your company or your clients thinking about how COVID-19 and the CARES Act impacts tax provisions. So COVID itself and the economic environment that we're in can have provision impacts, and then obviously the CARES Act being passed on Friday has big impacts to the provision. So first part, I'm going to speak to interim I call it FIN 18, estimated annual effective tax rate approach. COVID-19 can obviously have a big impact on a company's ability to forecast, and that is one of the requirements of ASC 740-270 is to have a forecast so you can calculate your effective tax rate. So companies could be seeing challenges in preparing a reliable forecast for their interim tax revisions, and that's a major part of an interim tax revision. In that case, the company may need to depart from the effective tax rate approach, or FIN 18, and use an actual ETR for the year-to-date period. So companies really need to consider their ability to forecast. Also, if results are, I'm just going to say, if results are funky, if you're getting really crazy estimated annual effective tax rates, you might have to depart as well. And we see this a lot with the last point, where operations are break even or perm differences are swinging things wildly. So major things to consider for your interim FIN 18 calcs. Next slide. So continuing on with the FIN 18, if you have interim period losses, which are likely to be happening to a lot of companies in this environment, you may be limited to how much tax benefit you can recognize. I'm not going to get into the depth of ASC 740-270 and the exclusions, but just know that some of those tax benefits could be limited under ASC 740. Other things to consider, obviously a lot of our companies' clients are global. You might have not only the US, but additional jurisdictions that need to be completely pulled out of the effective tax rate calculation. Next point that I think a lot of people might not consider is there could be material changes to state apportionment. Sometimes we don't always think about the state rate, but if your business is heavily impacted in one state or another that's more impacted by COVID or less, you could have material changes to your state apportionment, your state rate, which in that case you need to recognize in this quarter. The bottom piece is just a lot of impacts of both COVID and the CARES Act are going to impact your provision in an interim period, and you have to consider what's rate versus what's discrete. And I just gave kind of a simple example below, where if you are planning on carrying back your 2020, let's say we're calendar 2020 loss, that would be in your rate. But if you're going to carry back a out of period NOL, that would be recognized discretely, along with the rate arbitrage for both of those. Next slide. So CARES Act, kind of a mini tax reform, which was passed on March 27th, which for a lot of companies, this is going to be a quarter end for them, whether it's annual or interim. So companies need to recognize the impact of the CARES Act quarter end in March 31st. Also below that, we can't forget about all the other global jurisdictions, other countries that are experiencing COVID crisis and maybe passing legislation as well. So we need to keep an eye on not only the US, but don't miss your foreign jurisdictions. The impact of the CARES Act, you could have deferred tax remeasurement, which is recognized discretely. Keep that in mind. The retroactive impacts of the legislation may require you to adjust your payables or receivables. So the NOL carrybacks are a really good example of that, where you may have to change that deferred to a receivable and have rate arbitrage as well. Last point I wanted to touch on here on this slide was, for right now, we don't have any SAB 118 type relief. This could be very complex to account for income taxes. And right now, we don't have any specific income tax relief. The SEC obviously has given companies the ability to delay their filing of 10Qs or 10Ks. So that's a conversation that you need to have with a client. They might be thinking, we don't need to delay, but if the income tax revision is going to be complex and there's going to be lots of modeling needed, maybe they do need to file for that relief. So next slide. So just a couple other bullet points. The valuation allowance. This is an item under ASC 740 that's going to be impacted not only by the market environment of COVID, but also by the legislation passed. So companies can now see themselves having to put up valuation allowances due to the market and the inability to forecast. But you also might be able to release valuation allowance if all of a sudden now you can monetize an NOL that you had a valuation allowance against. So valuation allowance is going to be very important to consider. We're probably going to have to see more scheduling of deferreds as forecasts become less reliable. Reversals of DTLs as a source of income in the valuation allowance analysis. So we're probably going to see more scheduling needed. The next point, APB 23, we have already seen this question asked on December quarters, January quarters, February quarters that haven't filed yet. This has been a new standard question that I think everyone is going to get, is how does this impact, how does COVID-19 impact your indefinite reinvestment of foreign earnings if you are using that assertion? So that's just, everyone needs to think about that. There might be more stringent requirements to do cash flow modeling, et cetera, to really prove that assertion. Whereas before you could kind of just maybe make a simple sentence that you have strong US cash flows. This could obviously have PIN 48 impacts. A simple example would be the qualified improvement property. A lot of people saw that as an error. Everyone knew it was an error in TCGA and decided to treat qualified improvement property as if there was no error. And so this would obviously release, if you had put PIN 48 up against that, you could release that PIN 48, interest, penalties, etc. And other examples. Goodwill impairment, we could see more impairment in this environment. That can have a huge impact on the provision if you have tax deductible goodwill, if you have component 1, component 2, understanding the impact to your tax provision. You can even get into the circular calc, which we see with tax deductible goodwill, tax component 2 goodwill. So if you're experiencing goodwill impairment, don't forget about the tax provision impacts. AMT, we covered that earlier. Just think that you might need some balance sheet classification. We still have some companies, clients that have it as a DTA because they think they're going to use it against regular tax, and you may need to reclass that to a current receivable if you expect to receive that within 12 months. The rate change, there is no rate change per se in the CARES Act, but we're going to see a lot of impact with NOL carrybacks to 35% or 34% years. So something to consider is your existing temporary differences, your existing deferreds, if they're going to reverse into an NOL that you're going to carry back, you need to measure those deferreds at the rate that they're going to be recognized at. So you could see your deferreds now being remeasured at 35% if they're going to reverse into an NOL that you're going to carry back. And that would be recognized discreetly in an interim period. So I think this is the last slide on ASC 740. I don't know, David, if you have anything else to add.
Well, I mean, yeah, I think obviously, again, we're not going to cover everything on ASC 740 here. We probably will have a separate webinar that we do that in, but I think that was a great summary, just showing that there's a huge amount of impact, both by the law change, the carryback provisions, as well as what's going on in the marketplace from a forecasting perspective and a change in business perspective. So I think these just highlight that almost everything on the tax provision has to be rethought and documented, and with a short period of time, unless the SEC comes out with some special rule that says, we're going to give companies, like they did with tax reform, a little more time to figure everything out, and you'll have kind of a measurement period to decide when you're going to book any benefits or detriments as a result of this law change. So we'll see if that happens. I'm sure there's people lobbying for that kind of treatment. So we'll see if that comes out. But so far we haven't seen any. So we're kind of really pushing through this with a lot of companies right now to figure this out. So trying to keep moving, because I know we want to hit a number of different topics, including some of the exciting stuff around the loans. So I think we're going to go pretty quickly, Matt, through the next couple, just to make people aware of some pitfalls as well as opportunities that are out there, not necessarily related to the CARES Act, but as a result of what's going on.
Yeah, thank you, David. To that point, we'll kind of breeze quickly through these slides. Just in discussion the last month with a few different CFOs, some which have completed a successful funding round, and others that were planning it for April, they're left with a precarious situation. When you look at the decline in valuation of a company and the need to raise capital, the need to raise funds, you're in a bit of a pickle there. Right now, if you look at where you would sit from a 3 to 2 ownership change perspective, if you have more than 50% change in ownerships over a 3-year cumulative period, you have limitations on your NOLs, and those are based off of value of company and interest rates, the AFRs. Right now, the AFRs are down to 1%, 1.2%, I think, as of April. So that's going to be hitting the 3 to 2 rate pretty quickly. So if you had to go out and raise capital with low valuation, you have a down round, low interest rates, your limitation is going to be pretty small. And then there's also proposed regulations that are out there, David. I think they're coming. They're probably going to be finalized here in the fall, and it eliminates certain provisions that we think are very huge benefits for our companies. The deemed recognized built-in gain provisions under 2003-65. When you remove that, that's going to further eliminate benefits to increase your limitation. So you're kind of in a pickle. What we want to do today is look at what you need to know where you are to know where you need to get to. So we're suggesting people perform 3 to 2 analysis just to understand what the changes on a cumulative basis to date. Understand their 5%ers and understand who the next funding round is going to be. If you have tag-along investors or if you have new investors coming in, is that going to trip a change? There's things that we can do to work through that. People look to change, have a change event happen when there's higher valuation. So there's ways to do that through cash issuance and small stock exceptions. So we're looking at those areas. Public companies are going to look at control premiums. Poison pill provisions are going to come back into it to defer triggering an ownership change. I think when you look at the NOL carrybacks, where the attributes are, 2 different tax rates on the carryback provisions, and ownership changes with the valuations where they are, you got to kind of lay out a roadmap to kind of understand how you want to order this, how you want to have your NOLs fall through and your credits fall through, post-change, pre-change, and then what makes most sense for your company. So it's not particularly related to the CARES Act. It's more related to the environment that we are in today. So next slide there. Unless Dave, do you have anything else to add on that one?
Yeah, the only point on 3 to 2, and I know there's more here, is that it doesn't affect carrybacks. It only affects carry forwards is an important point. So, but it can obviously, as Matt said, have a huge issue between the rate, as we covered there, kind of 1 and 2, added together with the low values really could cause a company that thinks they're going to have NOLs for the next long period of time to have a severe limit on them. That we think that rate actually is going to continue to fall under 1%. So again, I mean, any number by that low of a rate, the amount you can use in any 1 year could be really limited. So it's just more of a, we're worried about this. We've seen this before when we've had, drops in value and all kinds of different transactions that companies do to survive. And you got to do that, but you also got to know what that's going to mean to your business. So maybe if we move on to the next item, Matt.
Yeah, so let's, we can flip through this one too. We talked about the recommendations already. We're kind of up on time. The other thing that we're seeing coming down the pipeline is valuations, again, as related to both private and public companies. Public companies is pretty simple to determine valuation to a large degree if you ignore control premiums. But what's happening with 401(a)? I mean, 401(a) valuations for companies, if you performed one and you're trying to issue stock or issue grants, is that value even good anymore? So you start looking at the impacts that could happen from a private company with the current market conditions. So in talking to some of our people in the valuation group, they're going to be looking at different methods and ways to look at valuation. Maybe just not that one method that you use for so long is going to be good. Maybe you have market multipliers, discounted cash flows, a combination of those two. But you have to really consider 409A, the relevance of it, if it's pertinent today, what you did before is even, I think it's probably stale. You probably have to refresh. Do you want to refresh in an environment that it is today? Sometimes yes, sometimes no, it depends on your situation. But we just kind of noted back to 2008 and 2010, what happened when the valuations declined like this? There's, what happened to your options? What happened to your employees that had these options? Did you do a repricing? Did you kind of clean slate and refresh? Did you convert these instruments into RSUs? What happened and how you solve that problem? We're all talking about this right now. So something to consider as you go through this year on what you want to do from a valuation front. Let's kind of click to the next slide.
So David Greenemeyer, did you want to touch on 165I, which is
yeah, I think
right now?
I'll quickly spin through this. This is 165I has always been around. It's a disaster loss 1-year carryback that typically had applied to hurricanes, fires, natural disasters, things of that nature. So the president, since he declared the entire nation to be a disaster area, a lot of companies can actually take advantage of 165I. So we've listed out a lot of items that can apply to 165I, but this gives you an opportunity to essentially calculate your 2020 disaster loss and carry it back to 2019. So if you go to the next slide, for companies that have cash with the IRS that could potentially carry this back, this is time sensitive because you have to file the quick refund by April 15th. That did not get extended. So if a company is interested in doing the 165I opportunity to get cash as soon as possible, they need to file that quick refund within the next couple weeks. And then just two other points, even if you're in a loss in both years, you could increase that 2019 NOL so that you could go farther back in years. And then just the last point, 165I does require very robust documentation. There is a rev proc you have to follow, a form you have to file. So just keep that in mind if this is an opportunity that you or your client will pursue.
Yeah, and it is a pretty, given the fact that it was declared a disaster, it's fairly unique. It's kind of like a casualty loss for corporations, and it can be a pretty powerful tool either way. Either if you're would have normally paid tax in 19 and you're pushing back the loss to 19 so you can get the money back or you don't have to pay it, or as David said, to make it part of the carryback that goes back further to get more money back earlier from an earlier year than 20 would go back to. So pretty powerful stuff there. So why don't we move on? And I'm assuming we have a polling question. No. Okay, so the one other thing here on the drop in value, and again, it's just a something to make note of, is obviously this is happening globally. And a lot of companies have cost plus entities offshore that, the standard is cost plus 5. That actually in some places has gone up depending on what you're doing in each jurisdiction, depending if it's R&D or marketing activities. But what we're pretty sure we're going to see is a lowering of the comp sets. And what we're starting to do with companies is start to build that in today so we can start adjusting transfer pricing down. And for companies that aren't paying tax in the US because they have losses, this is an ability to lower how much foreign taxes that you're paying that aren't doing you any good, especially related to what's happened with tax reform and those credits not being able to be used after the year that you generate them. They don't carry forward anymore. So there's a whole lot of reasons for companies that have international structures to take a look at their transfer pricing, and if it's a sizable amount of foreign taxes, start thinking about how they can use mechanisms to document why they should lower that starting right now instead of waiting till, you know, the comp sets come down with the 3-year averages. There's also the opportunity if you have, you know, COVID related shutdowns or expenses in the foreign jurisdictions, there might be ability to not cost plus those or pay the foreign subsidiary for those because the US company didn't receive any value associated with it. So we're looking at all kinds of things that we could manage the cash dollars that are going out the door that don't give us any benefit potentially in the US. So it's another area definitely to look into if you have significant foreign subsidiaries that have profits. So now I'm imagining it's a polling question.
It is. One more polling question. Really quickly here. Which area of tax opportunity interests you the most? Section 382 NOLs, valuation 409A, transfer pricing, 165I, unsure. We've got a few more slides to get through, so I'm going to make this pretty quick. We'll close the polls in 3, 2, and 1.
Great. Okay, so now we're going to go on to, I know something that everybody's talking about today. I've been emailing people about this since about 3 o'clock in the morning, our time. Obviously, if you're watching any news network, there's a ton that's going on around these loans that potentially can be forgiven. So we definitely want to hit and cover especially that and some of the other areas that that we're seeing these days. And again, this is definitely top of mind that we're working with a lot of clients through today. Take it away, Mr. Matt.
Oh, fantastic. Thanks, Derek. Yeah, just watching the news this morning. PPP was all over CNN, so that's fantastic. We got the headlines. There's programs out there. Some of them have been in existence for a while on the injury disaster loans, but really people are focused on the CARES PPP program. So let's flip the slide and talk about that really quickly. As it relates to the CARES, the payroll protection program, beneficial, maximum loan $10 million or 250% of average monthly pay expenses. There's loans by the letters of delegated authority under SB 7A. The interest rates are 4%, terms up to 10 years. That's great news. But really what it comes down to is the use of those funds and the forgiveness feature. If you use these funds properly, and that's goes for wages, interest, rent, utilities, you have the ability to have the loan forgiven. So it's the closest thing to free money we've ever seen in the government. It's a fantastic program if you qualify. There are some requirements in there. There's a 500 employee cap, and we'll talk about some of those interesting nuances, I guess, as it relates to ownership and control and venture-backed companies. Let's flip to the other one. The other loan program is next slide, please. SBA Disaster Loans, not as beneficial. Again, $2 million is the max. They come from the Treasury. You have to have collateral. There's personal guarantees. There is no forgiveness, and there's interest rates involved. So if you don't qualify for the PPP and you still need to get funds in place, there is the EIDL program that's out there. For companies that are larger, 500 to 10,000 employees, there is also another relief measure. Title IV loans are out there. It's a 6-month deferral of any payments, 2% interest rate. So it's still a good program for companies that still need to get cash in the door, backed by the government. Again, 3 areas that we focus on. There's another piece that's smaller out there, another $10,000 loan that is forgivable, or grant. But we don't have to address that here. But let's kind of flip to the slide and get to the stuff that's actually happening in the news. So what everybody's concerned about is, where are we today? What's happening with the PPP? It's on everybody's mind. I haven't seen so many questions on one topic for a long time. They had guidance come out I think it was a Thursday. They had guidance come out, and they were supposed to have the program rolling out Friday morning, which is today. Many banks are accepting applications. Bank of America is accepting applications. I saw a couple submitted by my clients. They showed me the application, the acceptance process, but the banks are sitting back wondering what to do. They still need more guidance from the federal government. They don't know all the nuances that are out there and the mechanisms in place to get the cash. They don't know, are we going to receive lump sum payments of this cash? Are we going to be staged of the cash? We don't know how that's going to be distributed yet. those things are going to come out. So the timing of these things are still up in the air. When you're going to get that cash, we still expect to have it part in 4 to 6 weeks. But the federal government has to start working with the banks quickly to make it happen. And we think that's going to happen probably over the weekend, and probably by Monday we'll have some new insights to share with you. Affiliates. A lot of people are going, what's happening with the affiliation rules? There's people talking about 20%, there's 50%. What does all this mean? The affiliation rules under the SBA is a much broader definition than what we would typically see for other things of affiliation concepts. They play a role in determining the eligibility for an SBA loan. And many have not looked at the impact that would happen. So if you have a look at Bay Area companies and venture-backed companies, and you have these VCs that are investing, my goodness, what's that mean for my company? If it's 50% or more ownership in the business by a VC company, that is affiliate. When you're affiliate, you have to look at not only that employees the employer's employees up to the 500 cap, but you also have to look at the venture cap fund itself, and to look through possibly to their portfolio companies in your employee headcount. So all of a sudden, a lot of California companies are going to be over the 500 person cap. That's not too good. There's also, if you're a minority interest under 50% for the VC companies, then there's control factors you got to consider. Control is the big definition. You have to go through facts and circumstances, positive and negative evidence, to determine what control means under the affiliate rules for the SBA program, to see if you're going to fall into that bucket. Once you're affiliate, it's a broad definition. You're looking at all the employees from the venture-backed companies funds and the venture-backed company portfolio companies, if they have control over those as well. So you're going to breach that cap quickly. Next slide, I guess we can talk about there. So I talked about this on the venture funds. Again, there's two things to consider there. The 50% or more ownership, that is control. If there's control, you have to expand your definition of the affiliates and start counting employees in the companies. If you don't have control, if you're a minority interest, it does come down to rights, obligations, corporate governance, their ability to create covenants. That's going to make a game changer on the control premium, and you're going to get to affiliate group definition there as well. People have asked me a lot of questions about payroll tax and PPP. Can we defer payroll tax and still take advantage of the payroll protection plan? Yes. We see no reason why you can't. I put some code sections up there. We think go ahead and take advantage of the deferral of FICA tax. We don't believe you'll be able to use any of the PPP proceeds to pay that FICA tax. That's still an obligation to you and your company to pay the FICA tax in 2021, 2022. Just don't use the loan proceeds from the PPP to accommodate that. Next slide.
Yeah, but Matt, I think the big thing there, and that's a question we get all the time. If anybody has any questions, feel free to reach out to us. But that is the belief that by getting the Social Security benefit, the 6.2%, and calling your payroll provider and having them pay that in, that does not stop you from being able to qualify for the PPP. I think that's the biggest point a lot of people are asking. Yeah.
Correct. We can flip to the next slide. I know we're running up against the hour here. But I think the other area to think about on these things, we didn't cover it on the slide right here, but you have the loans, you have the grants. You also have certain credits that exist out there. The employee retention credit, it's $10,000 per employee per quarter, caps at wages of $100,000, so there's some proration there, but a very valuable credit. In that regard, you cannot take PPP and employee retention credits. You got to bifurcate those and understand which one's going to be more valuable. That's the roadmap that we want you to develop, so you can understand where the cash is, how to get it, and the best way to go. Best way to obtain it.
I do think that those overlap, and definitely can't double dip. I think that's caused some level of confusion on the Social Security deferral being a payroll deferral. So that is probably one of the top questions that we're getting in the chat room for sure is, can you do the Social Security deferral and the PPP and the payroll credit? So you can't do the Social Security and the payroll credit, but you can do the PPP and the Social Security, but you can't do the payroll credit and the PPP. So that's why it's so confusing, is because there's different provisions that came through the law at different times, and they put in making sure people didn't double dip But hopefully that helps a little bit in terms of what you can do. We definitely think everybody should be deferring their Social Security taxes. It's basically an interest-free loan from the government over a pretty long period of time. So
12 they're going up 20.
I guess in summing up, I mean, obviously we've covered a ton here. We've covered the federal income tax and state ramifications. We've covered some provision effects, some of the different laws, and possibly potholes that you could hit, like 382 and some of the other areas, stock options and 409A valuations, transfer pricing and minimizing other cash taxes. There's just so much going on today with the combination of the CARES Act and the other provisions, as well as the impact to the economy, that we all got to keep monitoring it, and that's what we're going to try to do. And we will continue to send out alerts and thoughts. And if anybody obviously has any questions, feel free to reach out to us to answer that we couldn't get to here. So let's take the last polling question so we can all get CPE. And want to move on,
David? Yep, thanks, David. So last call question, kind of a quick pulse for you. Would you like to receive a call from us to discuss any of the issues mentioned today? As David's saying, yes, you know what you need, and you need some help now. Yes, but you're not sure what you need, or no, we'll just get an email, you'll get the slides, and potentially a follow-up if that makes sense. Get those answers in. We'll close this out in 3, 2, and 1. All right, any ending words there, David?
No, I think as we all said, I mean, it's really a lot going on, and so we're going to keep following it. We'll keep trying to do alerts and webinars as we think needed, and appreciate everybody dialing in. Be safe and have a great weekend.
Thanks all. Bye.